Good Monday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, let's take a look at the share disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or broker dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, is for informational purposes only concerning Market Chameleon tools and products. Also, before we get started, be aware I have a serious head cold, so there could be sneezing, sniffling, or a serious cough
Um,
throughout this entire show. I'll try to mute myself, which I do when I get these things, but anything's possible today. Morning,
okay.
D.
Thank you for that morning. Well, good morning. Hope you feel better. Um, Let
Yeah,
me
well,
go ahead and share my screen here. Um, if and I think today what we're going to do is come back to our long call screen. And by the way, I've also been feeling like I have a cold coming on, so hopefully, I don't sneeze and uh, cough. But today, I think what we'll do is come back to our long call option screener. We started this last week. If you're looking for it under screeners, if you go ahead and pick long calls, you will come to this long call option screener. And this screener analyzes um, single leg options and all these, the available stocks and call options to trade, and it looks at the ask price and then analyzes it from that perspective. If you bought the call option and you're long that call option, it goes through different types of data and analytics in this table, so you could narrow down potential candidates. And we discussed and covered a lot of these tabs here last week that provide analytics to help either evaluate or um, assess the potential value, risk, and rewards of this option. So you could narrow down candidates by different criteria and then to perform further research. And as you could see here, we default to the next monthly expiration on the screener. You could change those expirations or give a range of days to expiration, and it will retrieve different expirations for you because call options, we have different expirations. We have different strikes to analyze. So you could use this filter over here, but by default, it'll go to the next monthly expiration. And what we'll cover today is looking at this tab, the market data. And if we have time, we'll also look at the volume and open interest. And some of these data elements will be added because of user requests. Okay, so let's say we did narrow down. I'll go back to the summary page, and let's say we use some of these filters and we looked at, for call options in December 20th. And let's say we're looking for positive theoretical edge of at least 10%. And we discussed this last week. So this looks at options where if we compared the market price to a theoretical value that we generated based on a model using historical stock behavior, that the difference, is at least 10%, where we're buying at 10, you could purchase at 10% below that theoretical value. Okay. Let's say, we're looking for something that historically, in theory, would have produced a positive result or profitability. We call win rate above 60%. So as you can see here, so I can get, so nothing popped up in that. Let me see, 50%. Okay. So win rate's about 50% over here. And since we have multiple answers, or candidates for like the same symbol, you can see Microsoft came up a bunch of times because it has different strikes, right, that met these conditions. We're going to say, just show me by symbol, for each symbol, the best one by, let's say, theoretical edge. Okay, so you can see your Apple, Microsoft, Meta. So we got now all these candidates for different stocks. So we narrowed it down. Let's say we wanted to continue researching it and looking for other data points to help us out. And on this market data tab, we'll go over here, and now we have, some more analytics here, and let's cover and see what these analytics help us answer. So from left to right, here we just have the stock details. We have the symbol Apple, Apple's price, and the change in Apple's price on the day. And then we have the details of the call option, which just gives us the expiration we're looking at, the strike price, the bid and offer of the option. So we're analyzing the option from the ask side in this situation, but you could see that the bid and offer is 10 cents wide. And of course, you always try to get a better execution. So you have some room there to perhaps get a better price. It's 10-cent wide market. This is the delta of the option. And this is the distance of the strike away from the spot price, to let you know, if a strike is way higher than the spot price, out of the money, it'll tell you by what percentage. If it's in the money, it'll tell you by what percentage. And if it's close to at the money, like over here, it's 1.3% away, it'll tell you by what percentage. It also gives us here quickly just a break-even price, so you don't have to do it in your head. But if you have a strike of, what did I say, $245, and you purchase this option on the offer $450, then the break-even price is $249.50. Okay. So that's just quickly providing that for you, so you don't have to do all of these in your head when you have a lot of candidates there. So then we could analyze this particular option by its implied volatility, historical volatility, we provide these different analytics, and these are volatility-based analytics. The first thing it shows us here is the actual implied volatility of this option. So each option can have a different implied volatility. You have different expirations, you have different strikes, you have skews, so you have bids and offers. So each option has a different implied volatility based on the option pricing model. The option pricing model takes inputs and then creates this output. One of them is implied volatility. So we get this implied volatility of this particular option in Apple, 17.3. Okay, now we have it. Let's perform some analytics on it just to give us some more information before we try to make any kind of determinations about this particular option contract. And the column next to it shows us the change in the implied volatility relative to the previous day's closing value. So just like a stock price, when you track a stock price change on a day, we reference the previous day's close. And then throughout the day, we reference the price relative to the previous day's close. At the end of the day, you get the close to close change. So this is doing the same thing on the implied volatility. And this allows us to know on the day, where's the pressure on the relative premium, up or down, right? So that's what we're talking about on the implied volatility side. because an option price can move up and down based on many different factors, such as the delta, like where the direction of the stock goes. The decay could make the option price value go lower because as you get closer to expiration, you get less time premium. But to get a relative value is the relative premium on the day moving up or down. We've referenced implied volatility because implied volatility will take into consideration days to expiration, the price of the option relative to the stock price. So are people bidding up or are they bidding down the implied volatility? We'll compare the implied volatility of the option now versus what it closed at the previous day. And we could see here that the implied volatility on this option is down 3.3%. Meaning that the IV is down, the relative premium on that option is lower. Okay. Even if the option goes up in value, the implied volatility could go down. Okay. And the option value could go down because the delta, the stock price goes down, the implied volatility could go up. So this is what this is tracking, is the implied volatility change of that option. So you can see here that was down 3.3% on the day. How else can we look at this IV? Well, if we look at 17.3, and we're trying to assess if we've looked at similar options. Okay, when we look at implied vols, the implied volatility, there's no implied volatility for stock. Really, the implied volatility is derived from option prices. Okay, the option prices are what creates the implied volatility from the Black-Scholes. So the stock itself on its own doesn't have an implied volatility. But options, we have different options. The parameters, characteristics of an options can be, we have different expiration dates, different strikes. So when we look at the implied volatility, we have to define, well, what options are we referencing? So like when we look at the VIX is reference it's a model that is tracking. It's a tracking model of a 30-day constant maturity implied volatility from the SPX. It comes up with this formula. And this particular option that we're analyzing is, December 20th. It's a 1.3% away. It's in the money. It has certain days to expiration. So if we looked at a similar option, right, not a 30-day, not a 60-day option, not an option that's 20% above that, the money. If we looked at a similar option with, same days to expiration, same distance away, and we looked at our historical database and said, okay, what is the implied volatility of a similar option? And look at our historical database and tell me, where does the current implied volatility fall relative to those historical observations, right? Are we on the high end or are we on the low end? Because we want to get a sense of, where we're evaluating this particular option. We want to know, is it on the high end or low end of its historical range? And there are different, we could compare it to the average, compare it to the high, low, or we could compare it to its IV percentile rank. So an IV percentile rank looks at in this situation over here, it looks at the last 1 year of data, and it says, okay, find me the observations of similar options in the last 252 trading days, if they exist, and tell me what percent of our observations were below the current level, right? So what percent of observations fell below 17.3 in this case? So that's 15%. So let's just say, to make it easy, we had 100 data points, right? 100 data points of 17, 18, 15, 19, all these different days, but the implied volatility moved around. Well, if we had 100 observations, that means 15 of those, 15% out of 100, were below 17.3, right? If you have 200 observations, that means 30, 15%, 200. So that's what this means. On the flip side, that means 85% of the historical observations were above. Okay, so that's given us a sense of where the implied volatility rank is relative to this specific option, which is very hard to do because you have to run an analysis on each individual option out there. So that's doing this for us, right? We're not comparing it to a single 30-day IV. We're actually going in there and creating a benchmark for each individual option that you're seeing on the screen. Okay, that's how it applies. So you're comparing more apples to apples. Then we could look at the option from another perspective. If we're looking at volatility, we'll say, okay, this is the implied volatility, 17.3. What about the volatility of the stock compared to the implied volatility? What if we just looked at the actual stock volatility and said, okay, if we looked at the historical stock volatility, how does that measure up to the options implied volatility? Right? Is there a big difference there? And if we look at historical volatility, we do have to define what dates are we looking at. Because the volatility of a stock, it's measuring the movement of the stock. Are we looking at, a certain date range? Are we looking at a certain amount of days? We have to define this, and it could be anything, right? We could come up with anything we want. Last 5 days, last 10 days. We could look at, 20 days last month. We could measure any way we want. So in this situation, we look at kind of like this would be the industry standards of when we reference realized volatility, historical volatility. Let's look at the last 20 days and see, well, what did the most recent volatility look like, and compare that to the implied volatility of the option. The implied volatility of the option is this is what the option prices are implying the next forward volatility from here to expiration. You could also compare it to the 1 year, a longer term. Maybe the volatility is lower in the most recent history or higher, but the longer you go out, it's smoothed out, right? The averages are smoothed out. So we could look at both of them. And here's what we have. In the last 20 days, Apple moved at the last 20 trading days. Apple moved at a 15.8 volatility. So you could see that the current implied volatility is a little bit higher than 15.8. What about the last 1 year? We took a look at 1 year's of volatility. So now you're smoothing it out a lot more. Well, that's 21.4. So here we have a couple more data points of information that if we looked at the implied volatility, if we looked at the just most recent volatility relative to the 1 year, we see we're below that. So Apple stock has been trading at a lower volatility in the last 20 days than if we compared it to its 1 year's volatility. And what we're seeing with the implied vols is that the implied vols at 17.3 in this option is saying it's going to be somewhere in between the last 20 days and 1 year. So it's not telling us, that it's going to be above the 1 year or at the 1 year. It's not telling us it's going to be right at or below. It's just saying what it looks like to me is that the market is pricing it somewhere it's giving it a weighted average between the most recent and the 1 year. Okay, 17 right in between. So it's giving some weight to say, okay, we're probably going to trade a little bit lower than the 1 year average, 21.4, somewhere in between here, which might be a reasonable estimate, if we have no other information. Then what can this 15.8 or 21.4 translate to price of the option? So let's say we're dealing here with IVs and volatilities, but if we took these numbers and plugged it into the Black-Scholes formula or the option pricing model, in this case, we're using, I think, the binomial. What would a 15.8 volatility, if we just decided to use 15.8 to see what the value of the option would be in theory, what would the price of that option be? And that is telling us it would be $4.05. So you could compare that to 450, right? And say, okay, if the volatility is 15.8 in theory, like the last 20 days, then this option would, according to the option pricing model, be around $4.05. So obviously this is 45 cents higher. What if we used the 1 year volatility and plugged in 21.4? Okay, that's our guess, 21.4. Then what would the option price be? That would be $4.73. So you can see here, that's a wide range between, 20-day and 1 year. You got anywhere between 405 to 473. And of course, that market price right now is in between these. Okay, these are the historical stock volatilities. So this is what the analytics is trying to help us assess, where the market prices are relative to historical ranges. Okay, that's what this page is trying to help us answer, relative to historical benchmarks and ranges. Where are the markets pricing these options at this moment? Okay, so I have one more tab here. Maybe we have enough time. I'm going to move from this market data tab, and we talked about some of these other tabs. And here's volume and open interest. And some of these have analytics also we added by user request. The volume and analytics, if we go from left to right here, we still have, Apple price and market cap. This tells us which call we're analyzing. Just as a reminder, the December 20th 245 expiration. Now we have these volume open interest analytics. The option trade count tells us the number of trades that traded in this option. The option volume tells us the total number of contracts traded. So keep in mind, a option trade could be one contract, could be 10 contracts, could be 100 or 1,000, but in a single trade. Okay, so the difference is there's a trade, a transaction, and each transaction could be a different volume, different contract amount of contracts. So that's the difference between trade count and trade volume. If we took the average size per trade, if we took all the volume divided by the number of trades, it's 10. Okay, so this gives us a sense of, on average, we're trying to determine on average what is the size of per trade. Is it very big trade, small trade, somewhere in between? This gives us the volume, this option volume, as a percentage of the underlying average volume. So if we took 11,000 and then just in this contract and divided it by the total option volume traded in Apple, what is that percent? Here it's 1.5. What this is trying to detect if there's an unusual concentration of volume in a specific option relative to all the volume, right? So if 100% of all of today's volume was in this one contract, this would say 100%. If you had two contracts that traded and they both had the same volume, let's say 100 and 100, then this would be 50% of the volume in this one contract. Okay, so here you could see here, these are maybe, here's a bigger one, 9.5%, but this just represents 1.5% of all the volume. So lastly, let's just go to the open interest here. And this tells us what the open interest is on this one contract. So 23,472. This tells us the open interest as a percentage of all of the open interest in Apple, which is 0.4. This here is just trying to tell us if there's a unusually high concentration of open interest in this specific option. So let's pretend that if this 23,472 contracts open in December 2245 expiration, if all the open interest added up to, let's say, 46,000, all the open interest in Apple in all the options and strikes. So this alone would be 50% of all the options, right? If this was the only open interest in Apple, this would be 100%. And we could just quickly scan and see, like, there's no, let me sort this. Okay, so here we have an 8%. So 1,700 options in this PNR. There's open interest in this December 20th, 105 strike. And that represents 8% of all the open interest in PNR. So not a high concentration, but a little bit higher percentage than we see in other stocks. And then this last column, open interest as a percentage of underlying average volume. This just shows us that what is the open interest on this option contract relative to how much option volume is there on average per day. Kind of like how many days would it take, for in volume for this open interest to accumulate. That's 153%. So basically 1,700 in open interest is above what this option trades on average per day. Okay. So maybe there's a little bit of a concentration of risk or open interest in this one contract. So I'm going to stop right there. I think we covered both tabs at this point.
Yeah, that was great, D. Thanks for getting through that without a sneeze or a sniffle. I must have had 20 here. So thank God for the mute button. Okay. Everyone, thanks for joining us. Remember to follow us on Facebook. Let us know if you see anything on Facebook that you'd like to have us add to the videos. As always, great job, D. Great start to the week. We will see you tomorrow, everyone. Have a great trade today. Thanks, D.
Thanks, everyone. Have a good day.
Bye.